please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hi, very good morning. You're watching Power Breakfast on CNBC TV18. I'm Ekta Batra and with me is Nigel D'Souza, and we have a lot to reckon with. Let's see whether we manage to sustain those record highs for our market.
Let's take a quick check on the Asian markets early morning. In fact, it's more or less mixed to kickstart trade. Let's pull up the Japanese index, the Nikkei. In fact, it had opened up in the green and it's currently holding in the green as well. Now, remember, we had some economic data that came out of there as well. So the domestic inflation numbers that are flashing for you on the screen just a short while back, that came in high by around 3.1%. We had a Reuters poll that said that, in fact, inflation numbers should rise by around 3.2%. So that appeared more or less in line with what the street was working with in the Japanese markets. And more importantly, the statements that came out of there said that, in fact, the Japanese economy continues to continue expanding at a moderate pace. So that market's holding in the green. But you pull up the other couple of markets. The Kospi, I think, it was trading more or less flattish. It moved around a tad bit. In fact, it's as flat as can be. And the other couple of markets as well should come up for you in the screen. Let's see what the initial tick is. More or less flattish. A bit of a negative start is what we could see. So a mixed bag coming out of the Asian markets today. And the SGX Nifty, as flat as can be, just to kickstart trade. But let's move on then. Let's continue with our focus on Asia. The leaders of two Korean nations met yesterday for the second time in a week as they try to hammer out details for North Korea's participation in the Winter Olympics that will be held in South Korea next month itself. Now, South Korea sees these talks as an important step in calming military tensions that have escalated over the past few months. CNBC's Jerry Kang joins us with regard to the outcome of that meeting.
The question is, will that Canada meeting on North Korea, will it actually apply enough pressure on the North Korean regime when we're not going to have any delegations from China and Russia? Remember, these two countries are the key players when it comes to sanctions implementations. Yes, we are also hearing that Reuters is actually reporting, citing a Canadian government source here, that the meeting will be focusing on sanctions because some of these countries really do not know how to implement these sanctions on North Korea effectively. But of course, when China and Russia is not there, maybe North Korea is not going to feel enough of pressure. Having said that, though, going back to that potential improvement between the two Koreas' relations, North Korea certainly on an ultimate charm offensive. So North Korea says that it will be sending a 140-member orchestra to South Korea during Olympics next month, and they'll be performing in Seoul, the capital city, as well as another city near Pyeongchang where the Olympics is happening. And of course, it's a little ironic, this strange relationship between the two Koreas, to say the least, because this is the same orchestra that actually performed to celebrate North Korea's September nuclear test last week. Now, I think last year, excuse me, but I think the real focus is really the meeting tomorrow that will be happening again between the two Koreas, because they really drill down to the cost perspective of this North Korean participation as well. It's a little hard for South Korea to say no, even if it doesn't like any of the terms at this point.
Okay, well, that's the latest update there. But the dollar index is hovering around 3-year lows. What's the impact the U.S. currency has, and what's the outlook for the market going ahead? Here's some opinion from Martin Leakos of Macquarie Wealth Management.
Clearly, the trade ramifications is a little bit of a confidence or lacking in confidence. But I guess the other side of it is that if we're going to continue to see higher rates in the US, you would assume the dollar can firm from here. And yet that hasn't been the case. Clearly, we've actually seen 5 consecutive decline weeks for the US dollar. It may well be that we're seeing a far greater influence on the US dollar around the hawkishness on other central banks around the world. We've really got a number of things tugging at the US dollar at this point in time. I guess the only beneficiary from this weaker US dollar clearly has been some improving commodity prices. The market seems to be comfortable with valuations at the moment. I think there's just too many positives at the moment for markets. That being said, we continue to be looking for, maybe it's a hope and a wish, for a pullback, but any sort of pullback we would expect would be certainly fairly shallow and short-lived. But the drivers, obviously, on the upside for equities is clearly the global growth scenario at this stage. The US tax cuts, that's adding not only both financial upside to US company profits, but also it's boosting confidence, there's no doubt, in the US economy. So again, quite an interesting scenario. Would love to see a pullback, but I think most of us are looking for that buying opportunity here if there were to see one.
All right, then, turning our attention to the European markets. Well, there was some profit booking seen on the three frontliners across the territory is what we saw. Remember, we have seen 2 weeks of gains. So those markets had come in for some mild profit booking. Three frontliners ending in the red, but the utility sector, that was the second top performing sector in yesterday's trading session. But turning our attention to the emerging markets, they did well. The Brazilian index was up close to around 0.5%. Even the Russian index did end with gains of close to around 0.3%. So emerging markets doing well, while the three frontliners, they ended in the red.
All right, and like we've been talking about the currency space, the dollar remains under pressure, though it has marginally gained versus the Japanese yen after disappointing producer price index figures from Japan. The euro has held on to overnight gains.
Well, and in the world of commodities, and crude oil prices edge higher on tighter supply and the OPEC output cut deal extension throughout 2018. Though a bit of a rise in US rig count remains a bit of a concern, Brent crude prices holding at around $70 per barrel.
All right, on that note, let's get in some opinion from Jonathan Barrett of Ayers Alliance Securities on commodity prices and the ones that he prefers.
I think one of the interesting observations we've had is that there seems to be quite a few commodities are actually in short supply. And when you look at the growth models that we're all looking at, particularly out of China, the US and also Europe, you can see that this weaker US dollar is only benefiting commodities, but over and above that, we're seeing supply shortages in some of the commodities. So as a result of that, I think you'll see that this commodity rally, which we've seen, even if we do get a dip, is something that I think investors would be wise to re-look at or continue to enter in good, strong, long positions. When you look at where copper is at the moment, we're actually forecast more of a shortage, deficits to the tune of about 50 to 60,000 tonnes. And there'll be a lot more issues, I guess, for copper producers down the track, given labour, given automation, given a whole lot of things. That'll only reinforce the problem that we have, and that the problem is that we don't have enough metal to meet supply. And as a result of that, you can see copper prices continue to extend their gains Q1 and Q2. So anything that's going to affect the supply, and we've got some big issues obviously in South Africa, that will sort of continue to forecast those shortages.
Well, back home on the Wall Street, the Nifty and the Sensex, they gained more than 0.5%, with the Nifty touching 10,750 for the first time in intraday trade. The Sensex as well rallied close to around 250 points. The Nifty Bank, that was the star yesterday. It ended at record highs, while the mid-caps, they were relative underperformers for the second day running. Anisha joins us early this morning to run us through all those cues. Hi Anisha, good morning. Well, yesterday, the DIs, they seem to have taken a break. After pumping a lot of money, they said, let's chill a bit, yeah?
Well, yes, actually, after looking at the stellar move, one would assume that there would be huge buying number coming as far as the cash market is concerned, but that is not the case, as you rightly pointed out. In terms of the FIIs, we have a net buy figure of just 33 crores, and DIIs also took a bit of money off the table because they sold around 173 crores in the cash market, clearly telling you that there is a bit of profit booking also happening in the market. But in terms of cues for today, well, they're more domestic than global. Of course, commodities and currencies are making headlines and lending cues to the market, but other than that, the US equity market was shut yesterday, so no major cues coming in from there. In terms of the European markets, the volume remained thin yesterday, given that the US markets were shut, but other than that, most of those markets closed in the red, with the German DAX being about 0.3% lower, though the Italian index gained around 0.5% in trade yesterday. If you are looking at the Asian screens right now, well, there are a bit of mixed cues coming in from there, because the Kospi and the Nikkei were holding up in the green. For the Japanese economy, remember, important statements coming in from Bank of Japan, wherein they say that Japanese economy is expected to continue expanding moderately. The domestic CGPI data has come in with a growth of 0.2% month on month versus an expectation of about 0.4% growth month on month. In terms of year on year, bang in line with expectations at around 3.1%. But other than that, we had the Straits as well as the Taiwanese index, which was trading in the red, and SGX Nifty was also a bit of volatile. It was in red earlier. The last time I checked, it was in the green, so pretty much flat as far as SGX Nifty is concerned. In terms of the domestic cues that I was talking about, the trade data came in yesterday. The merchandise trade deficit is at a 3-year high in December now. The economists are saying that maybe it would put pressure on the current-account deficit as well. Remember, there was a decline in the pace of growth of non-oil merchandise export that the economists were worried about. So let's see what the reaction to that one is. Other than that, a lot of important hearings and cases today. But in terms of the important levels to watch out for the markets itself, well, analysts say that on the upside, levels of 10,780 to 10,800 can also be seen if the upside continues. But on the support side, they see around 10,713 to 10,690 as an important support level. Back to you.
Okay, Anisha, and what about stocks?
Well, yes, a lot of stocks to watch out. It's the beginning of the results season and we have a lot of numbers to look forward to. So in terms of the Federal Bank numbers, they were operationally a bit weak. The fresh slippages came in at 412 crores, but the loan growth declined to just 22%, something that the street might not be too happy about. In terms of Delta Corp, however, strong numbers coming in because the revenue grew by 57% and the profit also at 44 crores versus 9 crore reported last year. ABC Bearings, good set again, revenue up 8%. But the profit jumped around 40%. Zealand, well, a good set of numbers coming in there. The base was quite low, but in terms of the revenue, that one grew by 72% and profit also showing a healthy jump. IndiGrid, well, that also reported good set of numbers. It looks like the company is on track to meet the FY18 guidance when it comes to distribution per unit. Other than that, we have Max Ventures, where they have approved fundraising of up to 450 crores via rights issue. Specialty restaurant, wherein they opened a mainland China franchisee restaurant at Colombo. So important development coming in for company there. Impasse, they have signed a license agreement with one of the companies, and that comes as important news because that is for 20 years for the use of the technology. Lastly, on Shriram Transport Finance, Fitch has reaffirmed the rating at BB+. So maybe a bit of positive reaction on that. Back to you.
All right, Nisha.
Well, India's trade deficit has hit a 37-month high at $14.88 billion in the month of December. Exports have grown over 12% to $27 billion year on year. However, imports outpaced that growth, surging 21% to around $42 billion this time round. Lata Venkatesh joins in with all of the finer details on the trade deficit.
So, $14.88 billion trade deficit is worrying. We did see one spike to $16 billion in November of 2014, but that looks like a freak because before and after we were at, 10 billion and 13 billion. We've never gone beyond that, but in the pre-taper tantrum days, we were averaging 14 to 17 billion. It is an unsustainable number for us monthly, unless we get $3 or $4 billion of FII or FDI inflows. We cannot sustain a trade deficit of 14 billion. We can manage up to 12 with 12 billion deficit. Beyond that, we are risking, we are at the mercy of foreign flows, portfolio flows. The second, similarity, gold imports had fallen to about, $1 billion, $2 billion in the years of 2014, 2015 per month. Now, for the last 3 months, they are averaging about 3 billion and more. This time it has come in at 3.4 billion. This means something like 73, 74 tons of gold being imported, and that will mean an annual run rate of 900 tons, exactly the number which was imported in the 2012 days. Again, very eerie. Crude, it's easy. Crude prices have risen, and of course, there is a pickup in industrialization, so that growth also by about 35%. $10 billion is a number we should be worried about. I just want to point out to one or two other worrying trends. For all the exports growing at 12%, ready-made garments are contracting by 8%. This is a employment-heavy industry. So are gems and jewelry. 2.4% at a time when gold imports are rising, doubling year on year, and even pearls and semi-precious stones are rising, but gems and jewelry not doing. Again, it's an employment-heavy industry. Man-made yarn, again, employment-heavy industry, not doing anything like other exports, just at 6%. Among imports, the worrying thing, of course, is gold and crude, but even electronics and pharma have shown some increasing imports, which is a bit worrying.
All right, Lata, thanks so much for that. Well, we spoke to a couple of economists and what they make of their reading on this number. Let's listen in.
I would like to see that the export growth rate at 12% actually goes higher. Because if you look into the oil imports, they have also soared, and that's basically the price impact. And there is another worrying factor which has been continuing for the last couple of months is the electronic imports. So I think this is some of the factors which are point of concern, and the contraction in apparel exports is actually a point of concern, because if you look into the US data, Office of Textile and Apparel of other countries, they are actually gaining in market share in the last couple of months.
On exports, the worry that I have is that we've seen a very broad-based slowdown in export growth. All of our major export-oriented sectors are showing a slowdown in growth in December compared to what was posted in November, and it's not just a one-off or one sector that's dragging it down, but it's very broad-based. Textiles, as you said, also gems and jewelry, a lot of the electronic and engineering goods sectors as well. So I think that's a worry. Seasonally, Q4 should be a smaller trade deficit.
Okay, so that's the opinion coming in on the trade deficit. There has been a slowdown definitely in terms of the export growth rate, even on a 3-month basis, not only on a month-on-month basis. But on to a CNBC TV18 exclusive. The Niti Aayog is in discussions with the Finance Ministry to formulate a comprehensive gold policy. Sources tell us that the policy think tank is likely to have suggested that import duty on the yellow metal be done away with. The Niti Aayog is believed to have suggested that GST on gold should be reduced from 3% to 1%. Also, we learned that the think tank has suggested some changes to the sovereign gold bond scheme as well.
Well, on to the latest on the GST front. Now, come January 18, the GST Council will meet for the 24th time, and this will be the last time the Council will meet ahead of the Union budget. CNBC TV18 learns that the Goods and Services Tax Officers Committee have made some key recommendations which they feel will go a long way in making return filing a simpler process. Timsi Jaipuria, who has been tracking these developments, joins us now. Timsi.
Well, the GST officers meet was inconclusive on the suggestions made by the Returns Committee whether to converge the 3 forms, that is GSTR 1, 2 and 3 into one, or try and exist and try and do with the system which is currently in place, that is filing of GSTR 1, 2, 3 separately and a 3B system. What we understand from sources is the fact that there are 3 options that the government is currently going to put forward for the GST Council to formally take a nod on. Firstly, to merge the 3 forms into one, or to merge only, that is GSTR 2 and 3, and exist with the current GSTR 1. We need to see whether government now needs to take a call on converging the forms or not is something that the council will decide. But yes, when it comes to the IT backbone, it comes to the laws. In either of these 2 cases, IT system would need an overhauling. Yes, we need to know that GSTN portal also would need changes and amendments in the SGST and CGST laws. But if you continue with the current system of having 3 separate forms and just try and simplify them is something also on the cards and on the agenda. We need to see whether the council decides on January 18 to how to ease the compliance burden for the taxpayers. But yes, once the 3 forms are converged, initially there could be teething troubles and we need to face them. That's what we need to see, and what the council decides is something a wait and watch.
Well, it would be ideal to sort of integrate all the 3 forms and make it even more simpler. But it is at the same time, I would say, it is not that simple. There are things to be still sorted out, and ultimately everybody has to be on board. The consensus has to be there amongst the members. And though it would be ideal to have it operational and make it simpler as fast as possible, we are trying to evolve the whole thing and decide on once for all on the 18th.
Okay, well, staying with the GST, the trial run for electronic e-way bills will also kickstart today. Remember, the GST Council has decided to implement the e-way bill system from the next month. In fact, the GST network has informed transporters that e-way bills would become mandatory for interstate movement of goods from the 1st of Feb.